You're listening to Chicago Stories, a podcast from City Hall featuring the stories of everyday Chicagoans and special guests, as told to Mayor Emanuel.
This is Mayor Emanuel with Chicago Stories. We're here with former Fed Reserve Chairman Ben Bernanke, or Dr. Ben Bernanke. Your parents paid for doctor, so I want to make sure you have it there.
Well, actually, I got fellowships for the doctor part.
Yeah. So, being Fed Chairman is 90% policy and 10% politics. So after you look back, did you learn anything about the 90% or the 10% that in retrospect in the rearview mirror?
Well, the politics part was pretty important because the Fed plays an important role, and it's important to be transparent and to let Congress know what you're doing and to be communicating with the White House and the administration. So I spent a lot of time talking to people in the legislative and executive branches, explaining what we were doing, particularly when the economy went into crisis, and obviously there was a lot of interest in what was going on and what we were doing about it.
Yeah, I do remember one of the meetings we had when I was in caucus chair. The idea that the Fed could borrow was an idea nobody ever knew, and that the number, I think it was $4 trillion, was more than, or purchase the bonds in what became Q2 or Q1 and Q2. It's a concept nobody had ever really explored.
Well, what the Fed can do, it's important to understand what the Fed can do. The Fed can buy assets, which is not spending. Right. Spending is the Congress's prerogative. But the Fed can buy assets, mostly treasury securities, and pay for them by creating reserves in the banking system. So the Fed can expand and reduce the size of its balance sheet. And we did that in quantitative easing as a way of trying to support the economy when interest rates had already come close to zero. We needed some other tool.
Ben, when you look back, I don't know if you know this, like when I became mayor, there was a little note in the desk from Mayor Daley, and I'll do the same. I don't know if that tradition exists from Fed chairman to Fed chairman, but if you were to write a note, and let's say the tradition didn't exist, but it was going to start with Dr. Ben Bernanke, what would have been the note to Janet Yellen in the desk of the Fed chairman when you look back through the Great Recession?
Janet and I worked together for several years before I left and before she became chair. So we communicated a lot about a whole variety of issues. But I think, being nonpartisan, being independent, being intellectually honest, doing the right thing for the economy, those were the main objectives of the Fed. And today the Fed, I think, is, in Washington, which is not overall running at a high level of efficiency.
You've noticed
the Fed is one of the places where you're getting, serious, nonpartisan, intellectually sound policymaking getting done.
You studied the Fed, and then you became Fed chairman. So what does Professor Bernanke tell former Fed chairman Bernanke? What would he instruct him?
Well,
if I can flip the two for a second.
Well, I found myself, I was a lifetime academic. I was a professor at Stanford, and then I was for many years a professor at Princeton. And I studied, as you said, monetary policy, Federal Reserve, financial markets, those things. And then I got the offer to come be a governor on the Federal Reserve Board in 2002. And I said to myself, I've been studying all these things for my whole career. Keynes once said that economists should try to be as useful as dentists. And I thought, well, I should try to be as useful as a dentist if I could and apply some of the things that I learned. And the things I learned as an academic were useful. They provided, we use a lot of models. We use a lot of statistics and data, in the analysis at the Fed. But I think, I also found myself as Fed chairman, listening to the complaints and suggestions coming from the academic community and then rolling my eyes and saying, these academics, what do they know?
Bunch of propeller heads.
Really. And I think the difference really is that there are parts of the job that being academic doesn't really prepare you for. And the politics is a big part of it, trying to deal with Congress and administration, but there's also dealing with the media, dealing with the markets. Communicating with the markets is a big part of what the Fed chair tries to do. And those are skills that you kind of have to pick up on the way and hope that you get some good advice. But those are not things generally that, as an academic, as you're looking at your models and so on, that you're thinking about very much.
Do you think the biggest change then is, if you think about it, I don't know the history the way you do about the Fed, but it was once shrouded in kind of secrecy. It was the behind the curtain. And you keep harping on the transparency in public and communication, that the biggest lesson out of the recession was a greater deal of transparency and predictability around the Fed. Is that not the biggest, but a big piece that is no longer can't operate in we know it all secrecy behind, and we'll just tell you when the smoke comes out of the curtain?
That is a big piece. I came to the Fed, well before the crisis, one of the things I worked on and thought about a lot as an academic was the importance of communication, transparency, openness. I was an advocate, for example, of having an explicit target for inflation, just telling the public, look, we're shooting for 2% inflation, so just so you know that, and you can hold us responsible for that. So I thought that was really important. It was one of my goals when I came to the Fed. But then as the crisis and the recession happened, I think they became even more important. They became important both in terms of markets because we couldn't cut interest rates anymore once we hit zero. So we had to explain to the markets what we were going to do, how we were going to react to economic developments. And so that communication was really important for getting policy to be effective and to affect markets the way we wanted them to. And then I think even more importantly, the politicians, the public were looking to us and saying, what are you guys doing? What's happening? Please explain to us. And to be legitimate, to have a legitimate ability to exercise the powers that have been delegated to us by the Congress, I think it was critically important for us. And I testified before Congress 80 times. And most of those were very substantial, 3-4 hours or more. Those weren't most pleasant experiences sometimes, but
well, I don't know. In Congress, we enjoyed it.
Yeah, maybe you enjoyed it. But
it was good. It was good for us.
It was entertaining, I'm sure. It's kind of like Gladiators or something. But it was important. It was important for us to tell people what was happening and to explain to Congress, what we were doing, why we were doing it. So I think transparency has always been important. I mean, people probably don't remember, but 25 years ago, when Alan Greenspan was first the chairman of the Fed, they would change interest rates and they wouldn't tell anybody. The markets would have to figure it out themselves. No, not predictability. They didn't even have a statement. They didn't even have a post-meeting announcement that they had changed their target for interest rates. So we've come a long way, and this is a global development, and I've always supported that. But again, in the context of the crisis and the recession, it was even more important. And I think one of the things that I'm proud of in terms of what the directions I moved the Fed was towards greater openness and better communication.
I know you've talked about the AIG moment. You call it the AIG moment. We refer to it in politics as the holy moment.
Yes.
With something after holy. What was your thinking at that moment?
Well,
I mean, because everybody looks at Lehman as kind of the point, the pin on the map that things on
that week. I mean, the week, what we call Lehman weekend and Lehman week. That was everything. Everything hit the fan all at once. Lehman failed.
We all keep coming back to that same word.
Lehman failed. AIG had to be rescued.
Right.
The money market funds went into panic.
Yeah.
And this was something that affected people, all over the country. Goldman Sachs and Morgan Stanley came under stress. Merrill Lynch got purchased by Bank of America.
Right. That was the week.
Wachovia, some big banks were taken over or coming close to failure. This was all in a week.
Right.
This was an enormous crisis, and this was a pinnacle point. And you asked me, well, why AIG? I mean, I think, our strategy from the beginning, and there were a lot of people who were skeptical, but our view was that once the panic got going, and I'm talking now about as early as late 2007,
right.
that beyond that point, that the collapse of a big firm was going to make things a lot worse. And so we worked really hard to try to avoid that. So with Bear Stearns in March of 2008, we were afraid that if Bear Stearns failed, that it would make the situation much worse. And so our strategy, we didn't have any way to save it. This was before the TARP bill. We had no capital. We wanted it to be taken over by another company. So we were able to arrange in March 2008 for J.P. Morgan Chase, a big bank, to take over Bear Stearns and keep it from failing. And that, for a time, that prevented things from getting a lot worse. When Lehman came up in September of 2008, we had exactly the same strategy. We had no way of saving the company unless we could find a buyer. And we had two potential buyers, Bank of America and Barclays. Bank of America, however, looked at Lehman's books, and like everybody else who looked at Lehman's books, it was in terrible shape, deeply insolvent. Its customers and its counterparties were running away. And Bank of America decided to buy Merrill Lynch instead, which turned out also was actually not a bad thing because Merrill Lynch was also a big company that was close to failure. So we got that one off the table. The other company that was going to buy Lehman was Barclays, which is a British bank.
Right.
But the British regulators said, no way, you can't buy Lehman because we don't want to make the British taxpayer responsible for this company. So they forbade.
So basically, they didn't want to import the America's problem.
So exactly. So it was the same situation as Bear Stearns, but with Bear Stearns, there was a buyer. With Lehman, there was no buyer, and so we had no way to save it.
Did we try to put pressure on the British, or you're not allowed to talk about that? Pressure might be the right
we talked
adjective.
Hank Paulson, the Treasury Secretary, I think was the point person. He talked to his counterparts there in Britain, and they said, sorry, it didn't work. So Lehman was not, I know you have a different view on this. Lehman was not a choice. Lehman was an inevitability. There was nothing we could do about it once the potential buyers disappeared.
Right.
Now, AIG was different. Now, AIG, that would have been an even worse catastrophe because this was $1 trillion global insurance company with huge interactions with companies around the world.
The infection would spread.
The infection, it was already spreading, but it would have become, I don't know what the medical analogy is, but it would have become probably fatal.
You're the only one that's a doctor in this room.
Yeah, But the reason we were able to save AIG was because the risky financial activities at AIG were taking place in a small division called the Financial Products Division, which was in the holding company of AIG. But underneath that holding company umbrella, there was $1 trillion worth of insurance subsidiaries all around the world, which had their own capital, their own profits, their own businesses. The one thing the Fed could do, this was before the TARP and so on, the one thing the Fed could do was to make a secured loan against good collateral. Lehman had no collateral. AIG had collateral. And so they were able essentially to pledge the entire company. They gave the government 9% ownership plus 11% interest to lend AIG enough money against the collateral of those insurance companies to pay make the cash payments it had to make. It had to make an $85 billion cash payment within a couple of days or else it would have failed. We didn't want it to fail. We knew it was going to be catastrophic. And fortunately, in this case, we had a way of helping it. And so it was not we somehow arbitrarily chose to save AIG and not Lehman. Rather, it was in the case of AIG, there were the tools and the conditions that allowed us to save the company.
I mean, that history slightly writes that it was, maybe I haven't read all the history, and maybe this is my fault, which is it looked like Lehman was more of a choice not to help it rather than you're saying there was no buyer in the market. It's somewhat not written that way in
I hope that history will
correct
itself because that's simply wrong. I was there. I know what people said. I know what the evaluations were of the professionals who were looking at the company at the time that weekend. I also know the New York Fed has just been putting out some retrospective studies on the bankruptcy process. Right. And even ignoring the 20% or so losses associated with the bankruptcy process itself, the Lehman creditors ended up getting less than half of their value. And that's despite the fact that since the crisis, the kinds of assets that Lehman held have increased in value considerably. But nevertheless, the creditors of Lehman are not getting their money. And that tells me this was a company that was not solvent. We really felt, I understand and we could talk about why people have that belief and so on, but my sincere belief is that there was nothing we could do about it. And then let me just say one other thing, which is that, Congress, even after Lehman, even after this catastrophic situation was developing, the first time we asked Congress to provide capital to help save the banking system, they voted it down.
Some of us were, I remember that.
Yeah.
And then, yes, Congress, I want to correct that. The majority of the no vote came out of the Republican caucus.
Yes, no, that's right.
Okay,
absolutely right.
Yes, it was the institution.
Yeah.
But Democrats actually put their a green light next to saving and giving you the tools to do what you had to do.
I
don't mean to do that, but it says we're correcting
that's right.
history
and also
here.
you got to give some credit to President Bush also, who was
100%. I've said it publicly.
So all that is true. But I guess the point I'm making is let's talk about a counterfactual world in which somehow or another we had gotten somebody to buy Lehman and avoided that. The whole system was collapsing.
Right.
Congress was not going to help until there was absolutely no alternative.
Right.
Somehow something was going to break, and that's.
No, my thing is I look at this as like you went Merrill Lynch, Bear Stearns, AIG, and not Lehman, and that 3 out of the 4, but the one is what kind of triggered it, and that tells you can be good. You can 75%. You get a passing grade.
You can hit 750. Doesn't help you.
Yeah.
And then of course we had Citi and Bank of America and Wachovia and I said at one point that something of the 13 or 14 biggest financial institutions in the country, something like 11 or 12 of them would have failed without government assistance, and that's an incredible situation.
Well, let me ask you this question and just do one different. You studied at Harvard. You studied at MIT. I don't mean to do this, but put those aside for a second. What of your life experience and background that you look back best prepared you for being the Fed chairman in a moment of crisis? And is there anything out of your life experience, not academic experience, that would you point to a Jewish child of a pharmacist coming out of South Carolina? I mean, is there something else in your background, maybe a class in philosophy or something else that you studied?
A couple of things, I guess. One is that I did grow up in a small town in South Carolina, very poor, one of the poorest places in South Carolina, which itself is not a rich state. And I worked as a construction worker and waited on tables and so on. So I did have some sense that this is trite. I had some sense that it's not an easy thing to put food on the table for your family. It's just, people work really hard. I mean, I saw how hard people work, and I understand that the kinds of hardship that a recession causes and that unemployment causes. And it's hard enough when you have a job and you're trying to make ends meet. And so when the economy, we did all we could, but when the economy went into recession, the Fed was quite aggressive in trying to do what we could to get the economy back to full employment. And we faced, and it was more Republicans than Democrats, but we faced a lot of political opposition and criticism about quantitative easing and some of the things we were doing. They were done with the intent of getting people back to work. I thought that was really important. The other experience I had, I had some experiences when I was in New Jersey at Princeton. I was on the school board for 6 years, and we were building schools, and there was actually lots of controversy because people didn't want to pay for new schools, and it was, and so working with a group of people, I was also chairman of the economics department, trying to deal with a bunch of prima donnas in the Princeton economics department.
That does not exist in academia.
No, not at all. But I think that there are skills related to working with people, trying to develop a consensus, trying to lead a large group. Those are things that you have to do in any substantive organization. But the Fed is a collegial place, and while the chair is the leader, the chair does have to develop a consensus in terms of policy. It has to balance the need to move quickly and responsively against the need to build a consensus and make sure everybody's on board. So I think there were some experiences I had that helped me there. And those were, again, some of the things that the pure academic part of my career didn't really prepare me for.
I always describe the TARP, or the financial bailout, as great policy and horrible politics. And I actually think it was a moment that triggered kind of the uncertainty and instability we are having internationally, at least in major developed countries, around the political system. The Fed had to get the tools, you had to get the resources, the banks had to get it. On the other hand, it really set off a set of politics against institutions and against the establishment that we're still, I think, are rippling through the system. Do you think there's any sense of culpability in the financial community or in the Fed about some of the issues that we're grappling with, not just politically, economically? And when you all meet,
so first, as you say, substantively, the TARP was very successful. It achieved its objective,
unbelievably
stabilized the financial system, and people don't realize it, that every dollar was paid back with interest. So the taxpayer didn't end up on the hook for any of that. So it was a successful policy, as you say, a very unpopular policy. I think I would question the idea that the TARP was somehow the critical element for our current politics. Clearly, the financial crisis, the recession made things a lot worse, both here in Europe, around the world. But, there have been problems, in our economy and our society that go back 30, 40 years. I mean, inequality has been rising since the 70s in the United States. Issues of immigration, globalization, technological change, all those things have been going on for a long time. People have been saying since the 70s that they thought the country was going in the wrong direction when you asked them in polls. So I think there's some long-term trends that are causing a political ferment, both here and in countries where the crisis wasn't as bad. Did the crisis make it worse?
Yeah.
Absolutely. I would just point out one thing, which is when President Trump does his rallies and he hits his hot buttons, he talks about China and trade and immigration and globalization. He doesn't beat on the banks. It's interesting. The Trump.
Well, maybe that's because one day he's going back to real estate.
Well, whatever the reason might be, but he doesn't seem to think that that's as important for his base as these other issues. So all I'm saying is that while this was an issue, I think it's not the only issue that relates to.
Look, well, then let me just make my point, and then we'll have this discussion about this, which is, and this is about politics, not about economics, which is the issues of immigration, globalization, and technology, and standard of living have been going on for 30 years. So what triggers? That means at any one point that political upheaval could happen. The reason I kind of say not TARP, but that whole financial meltdown, is I actually think the public thinks it was, we put together $800 billion for a bunch of people who they think never actually, any of them paid any price professionally for what they think they caused. And I used to say the reason I wanted that we should have done financial reform more aggressively and earlier was there was a need actually in society for some what I call Old Testament justice. And that never really emerged and then I think there was a sense that we were bailing people out. I remember the arguments about they didn't want any curbs around salaries or income. And people were like, who's going to, they thought they were writing a check for $800 billion. And there was no sense of either culpability or penalty. And that's why I think it had a trigger I'm not saying that the income inequality, stagnant standard of living, all those have been around. So what triggered this particular moment that England, France, Germany, Italy, the United States are experiencing? It was great policy and just horrible politics.
No, I don't disagree that the politics is horrible. Full stop. I mean, I agree with that. Again, I guess I think that there's a whole bunch of things. I mean, we've had populists before going to Ross Perot and people going back, but this moment, I agree that the whole bunch of things have come together. An important event that may have contributed to this timing is China. China came into the WTO in 2002, and there was what economists call the China shock.
Right.
Disruptions caused by opening trade with China. I'm not denying at all that this was a big negative from a political stability point of view. I'm just saying there's a bunch of things that contributed.
Do you think China coming to the WTO was wrong, or keeping China in the WTO but letting it be rated a developing rather than developed?
Well, I
mean, it's the second largest economy, and we still call it a developing economy.
Yeah, I think that there was an expectation and a hope that bringing China into the world trading system would make them
collaborate,
make them open up more,
Right.
make them become more Western in their economic model and in their diplomacy and so on. And it hasn't really paid off, as much as American and European policymakers hoped. And I think and I think this is important, even if it had, there was a lot of disruption caused by the accession of China into the world trading system. A lot of companies, put jobs overseas and so on. And I think we, the country, could have done a better job of helping people in America adjust to those changes instead of just leaving them on their own, essentially, to figure out what to do.
I take, looking back, since I was around the White House, at both for the China WTO and then NAFTA. And I think, look back at this policy-wise, I think in retrospect, where the elite and the policy people got big things wrong. Not that the trade is wrong, and I'm supportive of open trade. Is one, the United States was doing a deal with Mexico's economy wasn't at the standard of living of ours. That trade deal had never been done like that, and it had to be done differently than every other prior trade deal. I don't think the policy people were that sensitive to that fact, and it would have an impact on America's standard of living. Second is it was sold as an immigration policy, not a trade policy, and it didn't really work as an immigration policy. It actually, when you look back at it, hasn't worked. Third, when you look at China coming into the WTO, it was being marketed, sold, buying into the international system. It would also be bought in as a developing economy. It's the second largest economy in the United States. It needs a revision. It's not a developing economy. It's quite developed. And it plays by a different set of rules, which allows that continuation of a disruptor rather than a collaborator in the overall health. And I look back and think, and I'm part of this, that a lot of us in the political policy world got some really big things wrong that set off this moment in time politically. Any sense of retrospect on that?
Well, no, this was the point
This is not supposed to be my dissertation, but that's my
no, but it's the point I'm trying to make is that if you put the whole thing on the financial crisis, you're not right. You're not right. I mean, I think the politics is a whole bunch of issues. Looking at Europe also, the immigration, for example, is something that is a lot of concern. And again, I would emphasize there's a lot of dimensions to it, and intellectual property and a variety of things. But I guess the thing that economists and policymakers did not pay enough attention to was, okay, these are big changes. They're going to cause changes in communities across the United States. They're going to change the mix of work. They're going to affect the amount of manufacturing jobs. It's probably a good thing to have open economies and to allow trade and to integrate our economies, but we have to help people adjust to those changes. And that's, I think, where we fell short, an important place where we fell short.
Do you think the Fed, not just the Fed, when I say Fed, I should probably say policymakers as a whole, missed the kind of inequality, immobility, standard of living, and should have been more sensitive starting when America was really accelerating its integration and globalization at a much faster rate starting in the early 90s?
Yeah, I think it's been a problem. I mean, this has been happening. The broadening inequality goes back at least to the late 70s. It was the 90s was a pretty prosperous period that kind of obscured some of this, but basically that's been a trend that's been going on for a long time. Economists are now very focused on it. They were not focused on it, 20 years ago. So I think that's a failing of the profession and a failing of the policy world.
Political world
as well.
failed at it too.
Yeah,
It didn't
absolutely.
issue. When you look at now some of the scholarly work, you said the New York Fed's putting papers out, et cetera. Is there any part of the Great Recession and the financial meltdown that hasn't received the amount of studying that exploration and research that now that we're on what would be the 10-year anniversary, that you say, you know what, these are like the 2 topics or 3 topics or 1 topic that really needs more academic and other type of research, and it's just being lost in this 10-year rearview mirror retrospect?
Well, I mean,
if you had a lot more free time than a Brookings Institute scholar.
I do research. I did a recent paper on why the financial crisis was so bad for the economy, and trying to point out how the impact on the credit markets and so on was so powerful in terms of causing the economy to contract and put people out of work. So I think the linkages between financial markets and the real economy is something that economists need to do more work on. I've worked on, actually, that was something that was in my academic career, something I worked on quite a bit. But that's the critical linkage in trying to understand how you can have periods of excess, like we had in 2007, the bubbles and the panics, and why that happens and why it matters not just for people in penthouses in New York, but it matters for the whole country. That's a really important issue, and I think work's been done on it, but more can be done. The other issue is that since the crisis, the underlying growth rate of the economy, what economists call potential growth, the productivity growth, has been also kind of depressed. And the question is, why is that happening? And is it related to the financial crisis? Is it an independent thing? How long will it last? Does it mean that interest rates will be low forever because rates of return are low? That's another set of issues that the recession and the crisis have brought forward, and a lot of people are looking at that.
I'm going to do a couple more topics, and then I know you have to go and stuff. But one is when you look back at the financial reform package, were there any things, and having been there with Geithner and negotiating this, are there any tools post the crisis, given the world today, that you think we should have done that were left on the editing floor that got missed and that are important tools both for the Fed, at the Treasury Secretary, and then the committee, whether it's the SEC or whatever, any agency that we need today we don't have and we're still woefully unprepared for the next crisis?
Yeah, I think, and I understand why this happened. I think that, well, first of all, that the system is a lot stronger than it was. There's a lot more capital. There's a much more attention to the broad system as opposed to individual components of it, so that there's more attention to the broad risks that could happen in a financial crisis. So I think overall the reforms were actually quite impressive given the politics and how difficult it was. And the risk, therefore, of a crisis happening in the first place, I think, has been reduced meaningfully. I think where there is still weakness, there are a few places, but the place I would point out is that if a crisis does happen, the tools that the Fed, the Treasury, the FDIC used to fight the crisis have actually been cut back considerably, and this was the political reaction to the bailouts, et cetera, understandable. But the things the Fed did, the lending it did, the guarantees of bank debt that the FDIC did, the Treasury's use of the Exchange Stabilization Fund to backstop the money market funds, all those things are now illegal or restricted. And if we had a big crisis, the Fed, the Treasury, the FDIC don't have as many tools as they
Ben,
would need.
I would just say this. I remember in Congress when you, Hank Paulson, and SEC Chairman Cox came up and said to the congressional leadership, we have 48 hours. And then there was a series, which was, let me just say this, that was a shock on us, that we had 48 hours. That was like our runway. And the other piece was that we had a lot of things that were done that wasn't in the rule book that nobody, I remember when Barney Frank said, what do you mean you can purchase up to an unlimited amount? I remember this distinctly because I was sitting next to Barney, and the explanation was the purchasing of assets. And I suppose you always had that power, and nobody knew that it was that big that there was unlimited. I think it was not that you didn't have the power, but it was there was no cap, there was no amount, and that you could purchase up to $4 trillion of assets or $100,000 of assets, and there was no cap. And there was just a lot of things discovered and a lot of things that you guys did that nobody thought the Fed could do at that time. And I think that one of the problems is, in retrospect now, is that people are cutting back on the power And it was those tools that actually were effective at the time.
Well, there's different tools there.
Right.
Quantitative easing is very different from the lending. So I think it's important to distinguish them. The Fed can still do quantitative easing if it wants to. I mean, it would have to make the political case for it, but technically it can do it. But what it can't do is make a loan to help stabilize a failing firm the way it did in the crisis. Right. And you may or may not think that's a good restriction, but it does mean the Fed has fewer powers to respond to a developing building crisis than it would have had even 10 years ago.
When you look at it and you look back at the bigger issues, meaning, do you think we're in a permanent time where productivity growth is going to be more, rather than kind of going up 4%, coming back down, et cetera, that we're in this kind of more of a flatline period of time where it may happen at 1%, not kind of these kind of spurts of 3 years of 3% and then pulling back? I mean, are we in a different period of time of productivity growth? And I know there's a big debate in the economic school. I know some people at Northwestern have written about this, Professor Gordon, that we're not, the big splurges of 20-year unbelievable productivity growth has come to a crashing halt. It's the end of history as it relates to productivity growth. Or you think that's overly
Bob
pessimistic?
Gordon at Northwestern has talked about, the kind of economy-changing technological innovations like the internal combustion engine and electrification and all those things that happened in the early part of the 20th century. And there aren't so many of those things, but I think there is at least one thing like that, which is artificial intelligence, and which has the ability, potentially, to make radical changes in a lot of industries, a lot of service industries as well. So we'll see. It takes time. One thing we also learn from history is that when you have a new invention, new technology, it takes a long time before it really shows up in the productivity statistics and in the economy. So it's not an immediate thing, but I think it's very possible that over the next decade or two that artificial intelligence and computing and other new technologies will begin to show up in a very big way in our economy. But then we're going to face a similar problem that we saw with trade and other developments earlier, which is sort of the cui bono, whose benefit is this happening? If there's for example, if self-driving vehicles put millions of drivers, taxi cab drivers and van drivers and so on out of work, do we have ways of helping them adjust to a new world? What will the new world look like? Mm-hmm. So we've already dealt to some extent with robots and manufacturing and so on. So I think the chances are good that productivity will pick up again over the next few years as new technologies, new methods of production come into play. But I think the more serious and difficult problems for policymakers and for the public are going to be, how do we adjust to the changes that that's going to bring in terms of our society, in terms of the kinds of jobs that are available? And I don't think anybody really knows the answer to that question.
I want to thank you, Ben, for participating.
Thanks,
There's a quick lightning round, and I don't know how familiar you are with Chicago, so we're going to see if you got this, okay? You ready?
Never lived in Chicago,
okay, but, you've been there, so,
yes,
okay. Yes. Do you like thick or thin pizza?
Thin.
Okay. Do you like the Cubs or the Sox?
The Cubs.
Okay. Do you like the Chicago River or the Chicago Lake?
The lake.
Okay. The Sears Tower or the Hancock Building?
The tower.
The Sears Tower.
Yeah.
Do you prefer 12-inch softball or 16-inch softball?
12.
Okay.
Does that make me a Chicagoan?
No, we're not even going to let you vote, and we allow a lot of people to vote.
People will say they want to be buried in Chicago so they can continue to be active in politics.
Exactly.
Yeah.
I want to thank Dr. Ben Bernanke for being here and for hopefully very informative about, as we look back on the Great Recession, but what we learned and what we have more to study.
Thanks, Rob.
Thanks.
You've been listening to Chicago Stories with Mayor Emanuel. You can subscribe and leave a review on Apple Podcasts and tweet your guest ideas using #ShyStories. Thanks for listening.